And our next guest says, quote, with real yields elevated, there's no need to chase risk assets. Joining us here on set, Post 9, Johnny Fine, Goldman Sachs, head of investment grade syndicate. He's the credit guru. Welcome back, Johnny. Always good to have you on a Fed day. What will you be watching this afternoon?
So I think the last time I was on with you was also Fed Day a few months back. And I think I said that was going to be one of the most important Fed meetings that we had for the cycle. I think this one's going to be one of the least important ones we have for the cycle. I think the hawkish pause is what we're going to get. I expect there to be a limited degree of market movement for pricing for Fed fund futures for the rest of the year and into next year following this Fed.
But it's a coin toss now for November and December.
Yeah, I think that's probably about right. Market's pricing in roughly 50-50 in either November or December. Will be data dependent. We'll see what things look like in the coming kind of 4 to 6 weeks. That will harden or soften the market's approach to whether there will need to be another hike. Jan Hatzius, David Miracle, our chief economists in the US and globally, view that we're at the end of the cycle now and we'll move into a cutting phase as we get into next year.
So does that mean we've seen the highs on Treasury yields?
Not necessarily. I think there's a number of headwinds that the Treasury market's going to face, even in a cutting cycle. We obviously have a sharply inverted yield curve. That's not normal. In the last 20 years, on average, the spread between Fed funds and the 10-year US Treasury yield has been just over 100 basis points. We're now 125, 150 basis points inverted, and there's a lot of work that I think that we need to see done just to get to flat. That may happen by the time we get to next year, but that, along with an increased amount of government borrowing to fund the deficit, I think will weigh on long-end yields. And so, if anything, I think there's probably more upward pressure on long-dated yields from here.
What are we seeing overall in activity when it comes to not just investment grade, but even high yield? I assume you can weigh in as well. Are we setting up for what could be a busier fourth quarter?
I think so. I think we've seen what we'd call a soft opening of the IPO market with some well-telegraphed deals coming.
Yes,
pricing.
Goldman Sachs has led many of them, in fact.
Yes, we have.
I think all three.
We're very proud to have done so. The high-yield market as well is certainly in a better state of health. The leveraged loan market is in a better state of health. We're seeing single B risk get placed in the primary capital markets. CLO formation is back as well. And so even though I think those markets will likely not see an amazing rush of supply going into year end, I think these soft openings are encouraging. There will be more activity. I think that sets us up well, assuming that we get ensuing performance. I think that sets us up well for a pretty good 2024.
Although if I'm a CFO, I'm trying not to issue into a market like this, aren't I? I mean,
into a debt market?
Yeah.
Not necessarily, because ultimately where we are in the spread cycle is pretty favorable. Where we are in the rate cycle is clearly less favorable, but unless you have a strong thesis that term yields are going to move down at a rapid pace as we get into a cutting cycle.
You need the money, you got to do it.
Yeah, and I don't think that's going to happen. So I think there will be a good level of activity.
Why not? Why won't yields crash, let's say?
Because I think we'll have ongoing supply from Treasury, and I think that we'll have an ongoing normalization of the shape of the yield curve. I mean, I think the right parallel when you look at 10-year yields, for example, is let's look at what that market was like prior to the global financial crisis. So in the early 2000s, before we had any QE, before we had other alternative forms of monetary policy, 10-year yields were 4.5%, 4.75%. And by the way, the economy did just fine in that environment as well. I think that's the right parallel to look at as to where longer-term yields might normalize for the economic environment we're in now.